As we mentioned earlier, 4 states in East Africa released their budgets for the 2013-2014 financial year today. Now, between them, Kenya, Uganda, Rwanda and Tanzania all have told their citizens to brave for 2 key things: higher spending and, in some cases, more taxes, not less. Let's take a look at the highlights from 2 of those key budgets. We're going to be starting off, as usual, in Kenya. The region's biggest economy has laid out its biggest spending plan to date. About 1.65 trillion Kenyan shillings, works out about 19.5 billion American dollars. The country's deficit for the next financial year is expected to be somewhere around 7.9% of GDP. However, keep an eye on this figure. The country's legislators want to cut this to limit it to no more than 4 percentage points. Exactly how they're going to pull that off is a completely different kettle of fish altogether. However, these are some of the key things you should be looking out for if you're an investor. For starters, a return of capital gains tax. It's been on the books for a while. However, its implementation has been suspended, and a 1.5% levy on all imported goods to fund the development of a standard gauge rail line all the way from Mombasa down on the coast all the way up to Kisumu on the coastline or rather on the shores of Lake Victoria. Moving on to Uganda, it's the 3rd largest economy in the region. It put forward a budget today of about 4.16 or so billion American dollars, crafted, however, in a very, very different environment compared to Kenya. Donor funding is estimated to have declined between the 2 fiscal years by over 90%, and that in turn has spurred President Yoweri Museveni's government to raise a lot more domestic funds. Now, this budget, if approved as is by Uganda's legislators, will raise taxes on a slew of things: diesel, petrol, kerosene, water, hotel accommodation, international calls as well. All of these are subjected to a hike in VAT and, of course, some duties as well. As I mentioned earlier, foreign funds will only fund about 18% or so of Uganda's budget. The country's finance minister has also proposed an end-to-end review of the entire value chain in the petroleum and minerals sector to ensure, I'm quoting here, the government gets maximum benefit from the sector. Exactly how that works out, we'll be looking at that in detail in just a few minutes. More details on Uganda now. Its 2013-2014 national budget included tax increases, as is just mentioned, which need to fill in the gaps and deficits from donor funding cuts. The Finance Minister, Maria Konuka, said it would be absolutely necessary for Uganda to receive more in domestic revenues by expanding its tax base. CCTV's Isabel Nakiri has the details from Kampala.
This fiscal year, Uganda will need to fund its national budget almost fully after seeing a drastic reduction in external support. The government says it's working on just 19% of donor aid, down from 25% last financial year. In the 2013-2014 national budget unveiled on Thursday by the country's finance minister, Maria Chwanuka, the government plans to increase taxes on domestic revenues, meaning the taxpayer will need to fund 80% of it. Chwanuka has projected the economy will grow if these new tax measures are adhered to.
The economy rebounded, significantly growing at 5.1% last year. Inflation subsided and was recorded at 3.6% as of the end of May 2013, a marked reduction from double digits at the start of the financial year.
The sectors likely to bear the brunt of the tax burden are fuel, kerosene, mobile money transfers and calls, as well as electricity and water. But Uganda's opposition party has criticized the budget, saying it's unfair and the country is not being provided with services in exchange for these taxes.
People of Uganda have no problem with paying taxes. Their major concern is that the tax payment is not commensurate to the services they get. To increase tax on sectors that can spur growth is very disadvantageous for an economy of Uganda that is performing at a rate of 5% per annum.
Uganda's central bank had recently revised down the country's growth rate as a result of aid cuts. But Uganda's President Yoweri Museveni said despite this, the country's economy has managed to pull through difficult times. Museveni said the economy would have done much better if it was not for corruption.
Corruption on the part of some of the actors also delays many projects and distorts decisions. It is true. Let us stop these and Uganda will roar.
The government intends to allocate the largest portions of its budget to the energy sector, transport industry, and it will also give priority to science and technology to help boost the economy. Despite the impact of aid cuts on the economy, the national budget indicates a steady growth, and now with a wider tax base, more growth is even expected. Isabel Nakiria, CCTV, Kampala.
Tax hikes were also the main focus of the budget presented today by Kenya's recently appointed Finance Minister, Henry Rotich. The $19 billion budget put before Kenya's legislators today aims to not only restore the enforcement of capital gains tax, but also impose a 1.5% levy on all imported goods to raise funds for the development of a standard gauge rail line from the coastal city of Mombasa to the port city of Kisumu on Lake Victoria. Now, the fiscal deficit for the next fiscal year is estimated at 7.9% of GDP, or roughly 3.86 billion American dollars. The finance minister also plans to reintroduce the value-added tax bill to Parliament for debate in the course of the year. Now, that proposed law is expected to raise at least an extra $100 million in tax revenues. Earlier drafts of it, however, have been heavily criticized for hurting low-income earners by reimposing 16% VAT on basic commodities like maize flour, milk, and wheat. As I mentioned earlier, 4 budgets in one day. That's a lot of data to crunch through. Let's get some insights from the experts. Nikhil Hira is a Deloitte tax partner for East Africa. He's live in studio tonight. Earlier on, Mr. Hira, the Kenyan Parliamentary Budget Office had indicated that there was a funding gap in Kenya's budget to the tune of about 163 or so billion Kenyan shillings. From the data you've seen today, has that hole been plugged?
No, I don't think it has. In fact, I think one of the disappointing factors today, Rama, was that they made their speech, they announced a few measures, but there was no real detail in there as to how the tax is going to be, the revenue gap is going to be bridged. It was a very, superficial speech almost, and we haven't even seen a finance bill, which I believe is not being issued until July. So I feel we're just as much in the dark today as we were 2 months ago or 6 weeks ago when the budgetary estimates and revenue estimates were released.
Indeed. Speaking of being in the dark, the Railway Development Levy, 1.5% on all imported goods, as stated in his budget, seems to apply pretty much across the board. But would that actually be the case in practice, or would it just apply to goods for local consumption and not goods in transit?
Well, certainly reading what he said and listening to what he said, he suggested 1.5% on all imported goods. However, I would think that our neighbours in Uganda, Rwanda and wherever else where these goods are transiting through Kenya will be a little upset if he does do that. So I think the reality will be when we see the legislation later next month, it will actually be just on imports that are coming into the country for home use, not for those that are in transit into the region.
Let's talk about Uganda. It's proposed a series of tax hikes, as we were hearing there from the Finance Minister, Maria Kyonuka, on everything from airtime, hotel accommodation, water, and not airtime, my apologies, international phone calls, water and fuel as well. Do you expect these to be approved by Parliament?
Interesting. I would think, like all other countries in the region, Uganda's got the same problems that Tanzania, Kenya have got. Revenue gaps, deficits. Must say that Tanzania has done a little better than the other two. So I don't know that the MPs will have a choice but to pass these things. Interesting enough, you talked about airtime and excise duty on it. Of course, we already have that in Kenya, so it seems as though we're getting a trend there. The other trend that I'm noticing is that a series of exemptions are being removed in Uganda and Tanzania. And if you were to look at our VAT bill in Kenya, that is exactly what that's doing as well. So I think, again, there's a trend to taking away exemptions and broadening the tax net that way.
Indeed. What stood out for you, however, in Tanzania's budget today? What are the key highlights that you saw there?
Well, Tanzania was interesting. A high growth rate, 7.1%, much higher than any of its neighbors. Unfortunately, the speech came out in Swahili first, so it took me a little time to decipher it. But basically, again, he talked about taking out exemptions, interestingly enough, reducing the bottom rate of tax, which I think is currently 14%, down to 13%. None of the other countries seem to have done that. So in a sense, a little bit more detail in his budget speech than the other two. But they're certainly facing, all three countries have got the same priorities: infrastructure, education and health, agriculture, and the youth bulge, as one of them called it, with our demographics moving towards a much younger population, a lot of whom are still unemployed. So all three of them were focusing on that aspect.
Indeed. We'll have to leave it there for the time being. Thank you very much for your insights tonight. That's Nikhil Hira. He's the tax partner for East Africa for Deloitte in the region. Let's move on to other matters now. United Nations Secretary General Ban Ki-moon has officially appointed Muhisi Kitui of Kenya as the new Secretary General of the United Nations Conference on Trade and Development. The UN spokesperson Martin Nesky said that Mr. Moon has already asked the 193-member General Assembly to confirm Kitui's appointment. Since 2008, Kitui has been the chief executive of the Kenya Institute of Governance. From 2008 to 2012, he was an advisor to the East African Community Presidents on regional integration. Between 2011 and 2012, he was a consultant to the African Union Commission, where he helped to develop a roadmap for a Pan-African free trade area. The former legislator holds a doctorate from the University of Bergen in Norway. Kitui will replace Supachai Panichpadi, whose term expires on the 31st of August. We're taking a short break here on Africa Live. Here's what's coming up next. We'll be exploring how informal markets in South Africa are helping to relieve chronic unemployment in Africa's biggest economy.
BizAsia. Asia means business.
At a quarter to the top of the hour, let's resume in Ghana. The Mine Summit there entered its second day today. The two-day conference brings together various stakeholders seeking ways of promoting investment in the mining sector, not just in Ghana, but across the rest of Africa as well. The summit is also aimed at helping stakeholders and industry players learn about the changing mining environment in Africa and the opportunities they offer, as well as exploring how governments are reforming mining codes and how to master mining risks. Ghana is also hoping to use this summit to reposition itself as a gateway to mining investment and business opportunities in West Africa.
We should try and change our thinking on how we see mining, because some people still think mining is so negative, in spite of the significant changes in the way mining is done. I know I've heard people who have said, oh, mining only returns 5%. I've seen even publications, 5% to the country in terms of foreign exchange, in terms of, and these are not facts. These are not facts, but they are things that probably happened some 20 years ago and have changed. But people are keeping those figures in their minds. There are a lot of things that you see people still keep, and they are not born out of fact. We need to help people to unlearn those things.
Further south, the platinum producer Lonmin says it has failed to reach a majority status recognition agreement with the Association of Mine Workers and Construction Union, AMCU, after a series of marathon talks, paving the way for a possible strike. Now, Lonmin has, of course, warned that a strike in that instance would be illegal. AMCU wants to be recognized as the majority union representative at Lonmin, as it now represents over 70% of the workforce at the world's third largest producer of the precious metal. AMCU, which has emerged as the dominant union in the platinum shafts after a bloody turf war with the once unrivaled National Union of Mine Workers, has also led two brief wildcat strikes at Lonmin in 2013. Lonmin, for its part, says it has increased security at its mines in response to violent and labour strife as well. Well then, quite a bit of mining news as well. Let's examine it from a different perspective. CCTV's Miriam Bemard is live in London right now. Miriam, the World Bank has been warning today of overheating in economies with inflationary pressures building up as well. How can African governments, especially those in commodity producers, avoid this trap?
Well, Rama, many experts here that I spoke with in Europe are saying that economies heavily dependent on commodities need to avoid falling into the bubble phenomenon. The key step will be for governments to push in place growth incentives for other sectors like manufacturing and skill set services. We have to consider that the demand we saw before the crisis was actually unsustainably high. What we're seeing now is sectors like commodities simmering to normal levels with demand leveling out. But the problem is that many developing countries are growing very quickly based on previous unsustainable demand, causing inflationary pressures. Now, analysts also agree with the report warning that markets may have to brace for asset price bubbles. So really, African governments need to shift their dependence now to cushion risk exposure.
Speaking of risk exposure, the report also did warn of a continued fall in commodity prices. Now, we've seen junior miners in places like South Africa, for example, already struggling. How then can companies on the mining front prepare their balance sheets for this cut in their bottom line?
Well, that's just it, Rama. These reports come out with so many forecasts, but not necessarily proper solutions. The growing trend among oil heavyweights, for example, that we've been seeing like Chevron and Apache is focusing on specialized rigs for LNG activity, for example, creating sustainable demand. In mining, analysts say companies have taken huge write-downs last year, and on the ground, even with production volume increasing 6%. 2012 marked the second year in the past decade that global mining revenue didn't increase. So miners need to rebuild market confidence. Capital expenditures are being tightened, already reduced for this year by 21%. The top 40 companies are also now only funding projects with a return of above 25%. In fact, research firm PwC says long-term global demand is still there, Rama, but ongoing uncertainty, especially in Western economies, has shifted the industry's center of gravity. And this is on par with the World Bank report saying overall global economy is entering a period of a normal, causing slower growth rates in emerging countries and, of course, moderating commodity prices.
Indeed, the spectre of uncertainty haunting the markets there. We'll have to leave it there for the time being, though. Thank you very much for your time. That's CCTV's Miriam Bemard live in London, talking to us about some of the key risks that we are facing right about now. Now, the trend of informal markets is growing in South Africa. Over 1.2 million people in the country now earn their living through selling arts and crafts and other retail goods. As Sumitra Naidu reports, informal markets are getting smarter and more diversified, and many are now seeing the market seen as a more lucrative business opportunity.
The informal sector is often frowned upon as being a low-value proposition that attracts those without much skill or education. Yet the sector is important for job creation and is a major contributor to the economy. So much so that the government wants more regulation in order to reap the rewards. According to government stats, there are 2.1 million people in South Africa active in the informal economy, with some estimating its value at around 28% of the country's GDP.
This market started about a year and 2 months ago. On average, on a good day, we have anything between 40 and 50 stalls. They're all the elderly, young traders who want to come and show their wares, a lot of arts and collectibles, some crafts, a lot of home industry. And the important thing is here that people come out to the park and enjoy themselves, and it's a relaxed environment.
Today, these markets are providing a less rigid workplace for those that have spent years in offices, and many believe it's a great business opportunity. Sumaya Worsdorfer lost her job just over a year ago. Instead of looking for a new job in the corporate world, Sumaya decided to become an entrepreneur. She did a short course on business management and is now running her own business at the local market.
Early last year, I found myself out of a job, very sad about it. And I just lived down the road, and then I walked down one day, I saw the market, and I came and I spoke to the guy who runs it. And I wanted to do food because I've done catering before. And he said no, he didn't want any more food, but he suggested why don't I start with spices. And I must tell you, I was quite offended because I thought spices, do I look like the spice lady? And I walked home and I thought not a bad idea, you know. And then I went the Monday, bought some products. And that's really how I started. And then I did a lot of research and I started mixing myself. and then I moved up to a different packaging. I designed a label, and then I started having fun. And then I also named the spices, and that took off really well with the crowd.
Unemployment in South Africa is at almost 26%, but the growing trend of different markets across the country is providing opportunities for people to make a living and become their own business owners. The overheads are low and the profit margins are high in most cases, especially where more niche products like arts and crafts are being sold.
All my stuff we make ourselves from home. I've been doing it for the last plus minus 10 years. It started off as a hobby, and now I do it as my own business.
While arts and craft markets are gaining popularity, the traditional street market remains an integral part of South African society. Street markets give people quick and fast access to everyday items. Food markets are also fast becoming the new trend in South Africa. Trying out tasty delights and buying homemade food items has become an appealing pastime over weekends.
I do very well with my gourmet products, which is the olives and the paste, and the pineapple chilies and sauces. So I do very well at the Florida market with the gourmet products.
For consumers, there's more choice and more opportunity to bargain for various items, and being outside of a busy shopping mall is also proving a more enjoyable experience for many. Sumitra Nadu, CCTV, Johannesburg.
Let's make a quick run through the markets for you just before we wrap up at BizAfrica. We start as we usually do in Nigeria. The market ending the day in the red by just over 3.8 percentage points. The all-share index in South Africa in the green by just a tenth. The 20-share index in Nairobi still very much in the grip of that bear run, down by half a percentage point. And the EGX 30 in Egypt up by 1.17%. Right now, though, onto the sports with Hamida.